Hi folks, David Waring here again with InformedTrades.com. In our last lesson we looked at technical indicators, which started our latest series on the subject. In today's lesson we're going to look at one of the more popular technical indicators, the moving average. So let's get started.
Okay, there are several types of moving averages which we're going to look at here, all of which are used by traders to try and smooth out price action of a financial instrument and get a better feel for the longer term direction without all the noise that's often associated with just looking at price. In addition to getting a better feel for the longer term trend of a financial instrument, most averages are also used to spot potential support and resistance levels and are often used in conjunction with one another to generate buy and sell signals. Before we get into the details, however, let's first have a look at the two main types of moving averages, the simple moving average and the exponential moving average. The simple moving average is the most basic type of moving average, and it's calculated by taking the past X number of points, averaging them, and then plotting the resulting line on a chart. The reason why it's called a moving average is because as new data points become available, the average moves forward to incorporate the new data point and drops the last data point in the series. So for example, if we're looking at a financial instrument here that has the following 10 days, let's look at a 10-period simple moving average, 10-day moving average, and then how we would calculate the first data point there is we would take the sum of day 1 through 10, divide that by 10, and then we would get 5.2 for the first data point, using this as an example. To get the second data point, the 10 days used would be day 2 through day 11, as the moving average shifts forward after the close of day 11 of trading. And so we would then, the 10 days used would be day 2 through day 11, divide that by 10, and we get 5.4. Okay? You don't really need to understand all the math behind this, as most charting packages, if not all charting packages, will calculate the simple moving average for you and plot it on the chart. And that's what it looks like there, and you can see how the price action is smoothed out using the moving average. The exponential moving average was basically created to do away with some of the weaknesses that traders were citing with the simple moving average, primarily that the simple moving average gives the same weight to each data point in the series that you're using to calculate the data points of the simple moving average. And basically the critics say there that the more recent data points, so if we're looking at a 10-day moving average, day, say, 9 and 10, should be given more weight because they're more relevant to future price action. So the exponential moving average was created, and it gives, what it does is it gives more weight to the more recent data points, and therefore it reacts faster to price movement. So here's the formula for the exponential moving average. I'm not going to go into the details on this one because it's much more complicated, but basically you just need to understand that the simple moving average is going to react slower than the exponential moving average because it's giving the same weight to the first data point in the series as it does to the last, where exponential moving averages are going to give more weight to the last data point in the series than they are to the first. Here's an example of what an exponential moving average looks like on the chart. You can't really tell the difference there, but I've included both here. The black line in this case is the exponential moving average. The blue line is the simple moving average. And you can see here that the black exponential moving average line is reacting faster as the market turns down there on the left. The black exponential moving average line turns down much quicker than the blue simple moving average line. And there on the right, when the market turns up, again there you see the black exponential moving average line moving up faster than the blue simple moving average. As far as which moving average traders use in their trading, in general, it's gonna depend on the time frame of their trades. If the trader is looking to capture shorter term price moves, a lot of times he'll use the exponential moving average because it's going to react faster. If he's looking to capture longer term price moves, he's going to focus on the simple moving average because it's going to generate less false trading signals. Okay. Lastly, they'll also look at the financial instrument that they're trading and the price action in relation to both the moving averages historically and incorporate their strategy into that, and look at which is giving better trading signals based on their strategy and the financial instrument that they're looking to trade. Okay, so that's our lesson for today. In tomorrow's lesson, we're going to look at some different ways that traders use moving averages to trade, so we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below, and have a great day.